Exactly a decade back, it was Hindustan Unilever's annual analyst meet in May 2014. An energetic Harish Manwani, the CEO of Hindustan Unilever then, walked into the ballroom at Taj Kolaba with a smile on his face. Manwani had enough reason for cheer. After a lost decade in the 2000s, Hindustan Unilever or HUL had finally got back its mojo. Over 5 years, until 2014, HUL had grown its top line by 58% and profits by 75%. The company had once again become a proxy for India's consumption-led growth. It was not something that had come easily to the company. In early 2000s, HUL suffered what was called a lost decade. The company's sales and profits had been flattish for long. Turning that around to a consistent growth trajectory was no mean task. In May 2013, Unilever had announced a buyback of up to 75% of its shares to increase its stake in the Indian arm HUL. This was to focus on product innovation, distribution and bring in nimbleness to take on competition from new age tech-enabled FMCG entities. Over the next decade, HUL focused on execution. The strong execution of its winning in many India strategy meant that growth in select rural geographies was 1.5 times the base growth. The focus on premiumization, evident in detergents and tea, meant that even in highly penetrated large categories, the growth was meaningful. The company's rigorous focus on cost savings also resulted in higher operating leverage. The real differentiator was HUL's distribution network. The company relied on its direct reach to 3 million outlets. The extended distribution network covered over 2.3 million outlets. And then there were the Shakti entrepreneurs. The Shakti entrepreneurs handled the remainder in the rural areas. Then came HUL's focus on data analytics. HUL realized that there were reams of data at its disposal related to trade promotions, media spends and competitive intensity over decades. Yet it hadn't been put into a system that was accessible by all. Christine Project Live, where the first 3 years was spent getting comfortable with the data and running hundreds of tests. This gave rise to the Shikhar app, where today 8 lakh retailers enter orders online. It allows the company to witness a demand slowdown or surge in demand of specific categories. In the case of sale of Lifebuoy hand sanitizers, for instance, during the COVID-19 pandemic, the company witnessed the impact of data in real time. Since late 2019, at Periyapalam, about an hour's drive from Chennai, HUL has put in place a massive automated quick dispatch center called Samadhan. Order information is relayed along a conveyor belt as pickers put in everything from soaps and shampoos to detergents and food products in pre-labeled boxes. They are then sent to a stacking system where they are loaded onto trucks along a predetermined route. So HUL now has several challenger brands in the D2C segment to counter new age FMCG brands. It is also a global push from Unilever, which saw e-commerce skyrocket during the pandemic. So HUL acquired online-only brands like Dollar Shave Club that helped it learn more about shipping D2C. Finally came the focus on artificial intelligence. HUL has AI labs now in Mumbai, Bangalore and Gurgaon, where it picks up signals on what consumers are searching for from the trade data as well as search terms on the internet. AI helped the company counter competition in organic shampoos, a segment dominated by new age companies like Mamaearth. But the crucial factor is sustaining margins. HUL has seen operating margins improve from about 16% in 2014 to 24% by the end of financial year 2024. During this period, both food and commodity prices were subdued. The reversal in these inflation trends is something that the top management is keenly aware of. HUL has refrained from price hikes in the recent quarters. In some markets, the company has chosen to withdraw from the low unit pack price points, and in some others, the grammage was reduced. HUL's sales and profits have grown at about 10% per annum in the past decade, and the company remains confident to retain a double-digit growth in the future also. Also, the operating margins can only catch up to that of its peers like Godrej Consumers and Procter & Gamble, which have about 25-26% margins. But the real question is HUL versus Unilever. The biggest quandary about HUL's valuations emanates from the comparison with the valuations of parent Unilever. HUL currently commands a multiple of around 50 times earnings, the current earnings. This is lower than the 10-year average multiple of about 62 times. However, the stock of parent Unilever Plc trades at about 20 times earnings. So, this wide gap in earnings is attributed to higher growth prospects of the domestic entity HUL. However, I believe it is the innovation in product development, supply chain and distribution with the help of technologies like AI which will help HUL stay ahead of competition. Moreover, investors should take note of the fact that when bought at an attractive valuations, the stock of HUL has sufficient capacity to deliver handsome returns over long periods of time, say decades. For instance, despite a lost decade, the stock of HUL has delivered a compounded return of 12.7% between 2000 and 2024. So, there is no doubt that the odds are stacked against HUL in the next decade if inflation eats into its margins. However, buying the stock when in distress could be the best way to take advantage of this trend. Hope you like this video. Thanks for watching.